Hey Art, how you doing?
Hey, good. How you doing, Mike?
I'm doing all right, man. So what is it that I can help you with?
Oh yeah, so somebody brought me a lead.
Mhm,
It's a house. It's a five bed, five bath
mhm.
house in near UC Davis, which is a nice area. So
Right.
it's on the I went to get the address and get the listing info from the photos, and I'm trying to figure out a way how to structure a deal
Mhm.
the offer to see if it's a good deal and if it's something that it's a um that we can work on and kind of like see how it works
Yeah, perfect.
do it
So
creative.
what I'm going to do is I'm going to show you kind of my thought process. First and foremost, we're
Okay.
going to figure out like what information is it that you need to even be able to analyze this deal, especially if you're going creative. And then I'll show you on
Hmm.
the calculator how you're going, like how you get a copy of the calculator and how you're going to, where you're going to plug in stuff in my process to then be able to determine what are the deal terms and what do I need to renegotiate them to. And then if
Hmm.
you're going to raise money, how much money needs to be raised by a capital partner, right? And I'll show you
Right.
where you can find that information for all of it through the school since you're one of our super investors. So let's start with the
Awesome.
classroom, right? There's obviously the six-part training. This is the bread and butter of this community. But when you go into lead generation, you go to the resources. The wholesaler deal checklist right here is the first thing you want to
Hmm.
grab a copy of. Every single time
Okay.
I look at a deal, I leverage something like this. For me, it's kind of like automated now. I don't need to like need this specifically, but this is a easy, handy dandy way to like figure out the info. So, you get your property
Oh, perfect.
information, you need the purchase price, right? If you have an agreement, if they have
Hmm.
purchase and sale agreement or contract, even better. But it sounds like this one's not under contract. What are the different entry costs you can account for? These are all the items you're going to need to analyze this deal, right? So I just put it in
Okay.
here first, and then you plug it into the calculator. So this is
Hmm.
the first thing you would use to get the right information, depending on the strategy you're going with. Then
Okay.
secondarily, well, let's go into the classroom. So under super deal analysis, if you go to the very bottom, is where you
Okay.
find the ultimate creative finance calculator, right? And you
Oh
guys get
wow.
lifetime access to this. So you click it. In my opinion, you take this and you bookmark it. You see how I have it bookmarked? Same with this one.
Hmm.
Instead of just doing the copy, you bookmark this and then you just have all these
Hmm.
resources in a folder. It's like, okay, here's the deal info checklist. Here is the creative finance calculator. You bookmark this page. So then when you click make a copy, you're always getting a fresh copy every single time. So you bookmark
Awesome.
the make a copy page. So you
All right.
bookmark this, then you click it whenever it's time. Like that's all I do too. I don't, I
Hmm.
don't do anything differently than you guys. So we're gonna say art, and then we're gonna go first and foremost. You're gonna start with the property information. This is the easy stuff. Where is it? What's the size? Yada yada, whatever.
Hmm.
Don't worry about the management strategy. You actually do this last.
Hmm.
You can select it now, but in my opinion, you
Hmm.
analyze everything that makes sense, and then you select which one's the highest and best use of that property. And then, in my opinion, the next thing you
Hmm.
do is you go into the creative financing purchasing calculations. So you go in and say,
Hmm.
okay, the seller is open to, um, this is the purchase price. This is the down payment they need. Like you put in this information. Is
Hmm.
it sub two? Is it seller finance? What is all that? If it's
Okay.
sub two, you can put in the dollar amount you're taking. Well, you have to put in the dollar amount of loan you're taking over, but the
Hmm.
monthly payment, you can hard code that and put in the number, the principal and interest on the loan,
Hmm.
separate out the taxes and insurance, right? But the principal and interest on the loan.
I
Or,
see.
in my opinion, the best thing you could do is recreate the loan here, the original loan.
Mm.
So if they got the original loan
Mm.
at $200,000, 3% interest rate, and their first payment date was 6/1/21, so the maturity date is 30 years from then, this will recreate that loan amount because then that feeds into the amortization schedule here. If
Oh,
you don't have
cool.
all that info, like the way you get that is the mortgage statement plus PropStream is going to get you all
Right.
that information you need. The mortgage
Mm.
statement will pretty much get you the correct interest rate, and then PropStream can get you the original loan amount, the loan terms, and the first payment date, or the maturity
Awesome.
date, which is just if it's 360 payments or 30 years,
Hmm.
30 years back from that. And that
Okay.
recreates this loan, right? In my opinion, then you go PITI, you put in, let's say the PITI is 1,500 bucks, right? So
Hmm.
then your escrow is the difference, right? It's 1,500
Hmm.
minus the mortgage loan payment,
No
right?
worries. Okay.
And you want to verify this
Hmm.
843.21 is on a mortgage statement. It's going to say principal and interest payments. You want to add those two numbers because
Hmm.
every single month the payment should be the same. It should be equaling this one if you recreated the loan right, right? You might have
Right.
to
Okay.
adjust something a little bit if it's not right, but you should. I've always got the right numbers. Um, so you have your escrow here, and let's say insurance is $100 a month or like $200 a month, right? So then your taxes are going to be the 656 minus 200, right? Because that's your insurance, that's your escrow, are 456.99. The only caveat is if the property has property mortgage insurance, that would also be subtracted away. And this is a good way to quickly determine your numbers to then plug in here, right? You have this monthly loan payment. If
Mm-hmm.
you recreate the loan right, that feeds right into here, which then feeds into here. If they're seller finance, you know that it's just the equity, whatever you're not between the
Mm-hmm.
purchase price minus the cash the seller or the down payment minus the sub two loan you're taking over. That's the equity left over that you're financing. We're saying
Mm,
here
okay.
it's 6% interest rate at 30 years, and this is the monthly payment. That also feeds into
Okay.
this right here. So now you have your sub two loan,
Okay.
your seller finance loan, if there is one, right?
Mm-hmm.
If you could
Because this
just do
one's almost like a sub to hybrid, like a.
if it's hybrid, right?
Mhm,
But if it's
mhm,
like you pay them all the cash up front, well, it's just a straight
mhm,
sub two deal. It's the purchase price minus the down payment
mhm,
minus the loan. There is no equity left over. You've paid them all of it
mhm,
up front, right? Or if you pay them no down payment, then you're taking over their loan and taking over the full amount finance, right? You adjust that based on actual deal terms, and that's how you kind of restructure it a little bit. All
okay.
right. So in your tax insurance, you plug those numbers in here. Because you plug in the annual, you would just put this so it's equals 456.79 times 12. Your taxes we said are 200 a month, or your insurance is 200 a month, which is 2,400 for the year. It's automatically putting in the monthly amount, right? Because you plug in the annual, it puts in the monthly. These are fed from elsewhere. And this is your long-term rental analysis. You get your long-term rental income here, then you
Mm-hmm.
fill in your expenses here. You have your
Mm-hmm.
management, your vacancy, and your maintenance and capex to account for your reserves. Then you plug in your entry costs based on the long-term rental management strategy. Does that
Mm-hmm.
make sense?
Yep.
So then you plug
Perfect.
it. So we did this. So this is step 3. The sub two balloon, if there's a balloon, I would probably put that as 4A, and then 4B is a seller finance balloon. It's not going to
Mm-hmm.
really make much of a difference for the analysis, but it helps you understand how long are you going to keep this, how much money you're going to owe them at the balloon.
Mm-hmm.
Then I go into the income right here. So I'll label this and I'm going to send you this copy. 5. Expenses, I would do that 6. And then you finish up with the entry costs, in my opinion, because honestly, when you want to renegotiate a deal, there's only so
Mm-hmm.
much you can renegotiate. You can only change depending on the debt. If it's sub two and it's no equity, right? All you can change is the down payment to the seller, which helps your entry cost.
Right.
If it's seller finance, you can adjust the interest rate or extend the payments, whatever you want to do to reduce the monthly payments. And that's the only thing you do to increase your cash flow. Outside of that, all you can do is
Mm-hmm.
adjust a few of these entry costs. So you want to understand this. Like, for example,
Mm-hmm.
if this deal, let's say right here, it's $82 a month in cash flow, cash on cash return is 1.8%. What I would do is I would adjust this interest rate to see at what point does this deal start making sense. Or my
Mm-hmm.
calculator automatically does that for seller finance. If you reduce the price and lower the down payment, when does that
Mm-hmm.
become a deal? In this instance, the cash flow is too tight. Lowering the entry cost is not going to make the difference.
Mm-hmm.
But even if you reduce the interest rate all the way down, even at a 2.5% interest rate, because it goes down 0.5%, even if you
Mm-hmm.
reduce the interest rate all the way down, you would still only get a 3.18% cash on cash return because the entry costs are so high.
Mm-hmm.
What you could do, what I like to do with seller finance, I set this to 0 first and see, like, does this make sense in any scenario? And it's 0% right here. So now you're still only $180 of cash flow, 4% cash on cash return, primarily because you're just not generating a lot of cash flow. There just is not enough spread between the rental income here
Mm-hmm.
and here. But you can't fake the rental income. What you
Right.
can do is you can change your management strategy, right? You mentioned a 5-bed, 5-bath.
Mm-hmm.
So then you go so underwrite all this stuff for the entry cost for your long-term rental. Like, what do you need to do to rehab it for a long-term rental, right? Not for a
Mm-hmm.
short-term, not for midterm. That's done elsewhere, but for a long-term rental.
Mm-hmm.
There's commissions, whatever, all that stuff. You're gonna have to plug in that info. And
Okay.
then you go down here, and I'd say this is number 8. I think I was on 7 before, right? Yep. So entry cost, and then you come to number 8, and you look at your analysis for different strategies. If this is not a great short-term rental property, you don't need to analyze it for a short-term rental. If this is too big for a
Mm-hmm.
good midterm rental, who cares about a midterm rental? If you're going pad split, just
Right.
analyze pad split if that makes it a deal.
Yeah.
And you said it's already
Yeah. I think
5-bed,
that's
5-bath,
what we're.
right? And
Yep.
then let's say you
Yeah, I was
add
looking
2 more
for.
bedrooms. So let's say it's 5 by
Mm-hmm.
5, which is phenomenal for rent by the room. Let's say you don't even add any bedrooms, right? So actually, this in this scenario would be 5. and 0, you're adding no extra bedrooms, right? And let's say this is my Atlanta numbers. In Sacramento, if we go to, do they have any data for Sacramento? I don't know. We can look
I
that up
think
real
the
quickly, but
Yeah, I think they didn't have as much, but I guess 1,000 per room average. There's like four because it's
a month
1,400
or
a
usually it's
month.
per week
Oh, per week. Oh, okay. It was they
for
calculated as much.
pad
'Cause I know
split specifically.
for
Let's
pad
just see
split.
what they
Yeah.
have.
Okay. Because they came in like 2 months ago and did like a
What the hell is this? Okay.
introduction here in California
So they don't
and
have
in
any
Sacramento.
data in Sacramento, but let's use Los Angeles numbers and just reduce it a bit, right? And they only have some
Mm-hmm.
in here. They don't even have a ton. Let's just choose one of these markets, just for example, just because it's the only other
Mm-hmm.
California market they have in here. We could look up Zillow. We could go on AirDNA. We could do all that stuff. I don't really want to worry about that for the sake of this example, because that's not, you're not
Right,
asking me to
right.
find you like the perfect rental income. Well, okay. You go on Zillow and you can look up right by the room. So Sacramento, they allow for that. So Sacramento, we're going to go to for rent. We're going to go to home type. How do you do? So the room, and say a house. We're going to apply that. So this is what they have there. There's not a ton of competition, which is great because there's a lot
Mm-hmm.
of people in Sacramento that cannot afford to live in Sacramento who have to live
Mm-hmm.
very far out. Depending on your location, it can be phenomenal. 1,000,
Mm-hmm.
1,200, 1,000, 1,300, 1,100. So saying like
Oh, that's
around
good.
1,200, if yours is nice and it's a private bedroom, private bath, then you're pretty
Mm-hmm.
solid. Like, could yours be comparable to this? So I think these are all private bedroom, private bath.
Right.
Once
Yeah.
again, I'm
Those are
not
high
focusing
end.
on
Yeah.
comps for you right now. We're just putting
Mm-hmm.
some numbers in for the sake of it.
Mm-hmm. That's really helpful.
Okay, so let's do that. We won't even worry about pad split data for
Mm-hmm.
this unless I can get something good. But
Yeah, they came in here
hey, it's an upcoming
two
market,
months
so they don't
ago.
even have data for it. Maybe they have one. No, they have nothing because it's brand new. Like California's.
Brand
Oh,
new.
here's one
Hmm.
maybe.
Right.
No, there's literally nothing right now. It's okay. So we know it's 1,200 or roughly 1,200 is
Mm-hmm. 1,200.
what's that? 400? No, 300 a month. 300 a month is roughly 400, right? It's
Mm-hmm.
1,200 for 300 a week is
A
1,200.
week.
Jeez Louise. All right, so we'll go that route. We don't need to worry about the 1,700. So your passive monthly income for 5 bedrooms renting at $300 a month is $6,500 of income,
Mm-hmm.
right?
Okay.
Yes, that's what it's saying. So your
Mm-hmm.
PITI is still the same as up above. Your utilities, you're going to start paying more utilities. Maybe it's more than this because it's California, but this is the placeholder that I put in for rent by the room. $600
Right,
to
right.
cover water, electric, gas, internet, trash, and landscaping.
Mm-hmm.
I would also personally, depending on how much profit you have, add $200 to $500 a
Mm-hmm.
month to clean the common areas, landscaping, all that stuff personally, because I care in the markets that I'm
Mm-hmm.
buying in, and like Sacramento's another one.
Mm-hmm.
It's a higher end market. You can get fairly good cost of labor to come in and take care of your property, and they're boots on the ground. They're eyeballs for you.
Mm-hmm.
So let's say you add $200 for cleaning a month. Let's say you use the pad split platform. So they're taking around 8%, they're taking 10%, or they're taking 100% of the
Mm-hmm.
first 10 days, but they're also taking 8% monthly. And then you add your
Mm-hmm.
own backup management as well. Or you personally, I know you're located there, so you could personally manage it, but let's just assume 15%, 8% for vacancy, which California, you're gonna have very little vacancy, especially Sacramento. It's not like you're asking to do this in a tiny, tiny
Mm-hmm.
market. And then maintenance and capex at 10%, which is the standard. You're generating even with paying all the utilities, doing the cleaning, and you haven't even added a bedroom or two. You could probably, depending on the address, you could probably add another bedroom or two to further jack up your numbers.
Mm-hmm.
This is when I tell people, like, I don't like to do pad splits that are under 6 bedrooms because it's kind of hard to make the numbers work. But if you're doing private bedroom, private bathrooms in a major city like Sacramento, and you're getting premium rental income, it could make sense. We have to analyze it as a rule of thumb, like
Mm-hmm.
the 1% rule, like whatever. That's what I say. 6 bedrooms or more. For years, you could probably add one or two, but it may not make sense
Mm-hmm.
to do so. We've already accounted for your furnishing cost. That's additional entry cost. And here are your returns. 1971, accounting for all your reserves and everything, 1971 a cash flow, 38.5% cash and cash return. Obviously, you and I know this is not real because these numbers are not real.
Mm-hmm.
You're not buying it for 240,000. You're
Mm-hmm.
not putting this entry. We need the real
Mm-hmm.
numbers, right? But that's how I would do
Mm-hmm.
it. I would do this,
Okay.
and then I would see if the numbers make sense. And if there's something I
Mm-hmm.
can adjust, which I talk about super investor, like, hey, what should you be
Mm-hmm.
adjusting strategically? Well, if they're seller finance, how can you maximize the cash flow? if there's entry costs that are high, how do you reduce that? Who do you negotiate with? How do you negotiate with the down payment to the seller, the agent
Mm-hmm.
commissions, maybe the wholesaler assignment fee? That's rarely what I want to do, but
Mm-hmm.
you can also pre-raise reserves. So instead of raising only 3 months,
Mm-hmm.
what I would do is I'd say, okay, well, for my reserves, I'm raising $3,000 a year or $245 a month based on the income. Or if we go to the pad split income instead, and we say the reserves are 10%, which is 650 or 7,800 for the year. Well, what is 2 times that? It's around 15,000, right? So what do my
Okay.
numbers look like if I add 15,000? I add 15,000 for 2 years worth of reserves and reduce this down to maybe 2 or 3%, right? You've increased your cash flow, obviously, but you're going from
Mm-hmm.
38.5% with this down payment or with this entry cost and
Entry cost.
without like, and just raising the money like this. Okay, well then if I add the 15,000 here, it's kind of the same actually. So it's kind of the exact same. 38, you actually a little bit worse, but theoretically I'd probably put this at 0. So it'd be a little bit higher because you've already raised 2 years worth. And the
Mm-hmm.
advantage there is when your capital partner brings in the money up front, instead of raising or instead of saving $650 a month, if something were to go wrong early on, you have $15,000 reserves to tap
Mm-hmm.
into immediately if you need to. Right. So that's
I see.
another little trick you can do to pre-raise reserves. It's not even like a trick. It's actually, in my opinion, less risky to pre-raise reserves and then eventually start building it back up once you get below a threshold, right? As opposed to just building it $650 a month. Because what happens in month 3, you have $1,800, but you have a $5,000 expense. You guys got to put more money into it because you didn't pre-raise it. So that's one of the things you can do to increase your returns to see if that makes sense. But the number one thing is to put in all the numbers, understand the highest and best use of the property for in this
Mm-hmm.
instance. It'll be pad split, right? Rent by the room.
Mm-hmm.
And then adjust the terms. The debt first, then the entry costs, and then maybe do something like that where you pre-raise the reserves. Is that
Awesome.
helpful to understand how
Yeah,
to do
that's very
that?
much, pretty much,
And
yeah.
then
I'll.
based on this deal, we selected pad split, right, as the management.
Mm-hmm.
So when you select that, it automatically feeds in. So you see it says 76,000 right here. Well,
Mm-hmm.
when I change this to long-term rental, you're not gonna be surprised. It's gonna be this entry cost, right?
Mm-hmm. Oh wow.
53,000. So when you do the pad split, all of the data, every single thing. So the long-term analysis is now based on the pad split management strategy. So like everything is based on the pad split. See, it's the $6,500 of rent, not
Mm-hmm.
the 2,450. And all the expenses are based on the pad split. Like it automatically
Mm-hmm.
filters for the full 30 years. It filters all that for you. And all the capital
Mm-hmm.
raising is dependent on whatever management strategy you select. That's why I say
Mm-hmm.
choose this. So what we say here, eight is additional management strategies. So I would set this as number 9. Once you determine what's the best use of the property, what has the best returns, then you
Mm-hmm.
go that route, right?
Okay.
Because maybe sometimes the long term, maybe sometimes the midterm, sometimes the short term. But in this instance, it was pad split. So then you select
Pad
the
split.
highest and best use after you determine that. And even better if there's one or two
Mm-hmm.
management strategies that work. In this
Mm-hmm.
instance, if you got to go long term, you're not making a bunch of money, but at least you're not losing money. And you know that, which is
Mm-hmm.
great. And if you pre-raised a bunch of money up front and you have the reserves, well, you don't need to save that same amount of 10% again. That will also help you out, right? So using up people's money, then
Mm-hmm.
this is where you go and say, okay, if I give, this is ownership, this is you, this is your partner. If I give 30% ownership and 30% cash flow with, let's say, a 0% for return, my capital partner is getting a 9.3% cash on cash return. So their cash flow
Mm-hmm.
they're receiving divided by the entry cost is 9.3%, which is solid
Mm-hmm.
because they also get all of this ownership benefit, the debt pay down, appreciation,
Mm-hmm.
interest payments, and depreciation,
Depreciation.
all that, the tax savings there. Their total returns is 12,143 divided by the 76,000 entry cost. That's a 15.9% return on investment. Let's say your partners need 10%. If you need 10% cash on cash return, you could either add a preferred return, just 1%. Oh, look at that. 1% at a time to get them that, because you're giving them more of the cash flow early on until they get all their money back. Once they get their money back, that preferred return drops. That's how you front
Mm-hmm.
load some of it. Or you can not do a preferred return and just give them more ownership, and that'll get them there as well. Right. So it's up to you.
Mm-hmm.
Like maybe you say, okay, 35, or maybe you give them less ownership. You give them the 30%, and then they get
Mm-hmm.
the preferred return to give them more cash flow to get them the returns that they want. In my opinion, for a lot of people on your first, second, third deal that you're raising money, just be fair and go 50-50, right? Whatever the returns are, and get a couple deals under your belt, because not only are you generating cash flow, you're generating debt pay down, adding to your net worth, you're generating appreciation, which is your properties are increasing in value, adding to your net worth, and you're saving money in taxes. But the fifth one, and this is what Pace taught me, is the story. The more good deals you have, the more successful partners you have, the easier it is to buy more and more. So when I started, I
Mm-hmm.
was giving 50%. And then it was
Mm-hmm.
like, okay, well, now I'm doing 40%. And I could garner that because my reputation and my risk level as a borrower was lower. And now we're at 20 or
Mm-hmm.
30% because of the reputation that we have, because of the story. The more properties you have, the safer you are, the more you work with people. Theoretically, if you're
Mm-hmm.
performing, you're safer. You can buy 100 properties and be risky, or you can do it the right way with deal analysis and make sure it's a great deal. The only
Right.
other caveat that I'll add is, because this thing cash flows 1971 a month, and the cash on cash return is 30.9%, you could instead of doing the a prime money partner, you could just go with a PML and you'd still generate $1,200 a month of cash flow, and your returns are still infinite, and I don't have to give up any ownership.
Mm-hmm.
So that's something to consider, right? In this instance, let's see, 14. In this instance, is what I talk about in the training. Actually, your money left over with the PML is higher than what it would be with a PMP. So it would even make more sense to go the PML route. But understand, in a year from now, you're gonna have to refinance that person or pay them off or something, right? So it's a different challenge. Like the PML, you're gonna have to keep paying every single month, no matter
Mm-hmm.
what your higher part performs. And
Mm-hmm.
this, when you start up and as a ramp up and it's a little slower in the beginning, no one gets paid because there's no like profit. But once it's successful,
Mm-hmm.
then everyone starts getting paid. It's like
Mm-hmm.
less challenging. It's an easier transition into raising money and buying real estate without as much pressure as the PML. If you don't pay, they can foreclose on you and take over your asset like that. So you
Right.
just gave them a great investment opportunity. So it just
Mm-hmm.
depends on your risk tolerance and kind of how you feel about your stress levels and all that. I say go
Mm-hmm.
PMP for a couple of deals, get really comfortable, and then either lower your PMP return or your ownership to other people, to new partners, or just go the PML route. You can do either. Is that cool? Was that pretty helpful?
Yeah. Oh, yeah. Pretty helpful.